Is the housing market headed for a massive crash, or is there going to be a correction? Today in this video, we're going to take a look at the data and see how you could prepare for the future. My name is Tommy Jordan. I'm a real estate agent and mortgage broker here in Southern California. Let's take a look at this article from Business Insider. Housing market not headed for a crash, correction in real estate likely. There's a lot of talk right now of the housing market being in a bubble, and a lot of people are comparing it to 2008 when we had the recession and the whole subprime mortgage fiasco, disaster. We're going to see today how the market we're in now is very different than the one before. As the Federal Reserve's decision to raise interest rates from near zero levels propels mortgage rates to a 12-year high, it's put additional pressure on housing costs, with housing affordability sitting at a decade low. Yesterday, the Federal Reserve raised interest rates by 50 basis points, the federal funds rate, and that's going to have a big impact on mortgage rates, and just the cost of borrowing is going to be more expensive. The Federal Reserve is looking to raise interest rates a few more times this year to combat inflation, and will most likely see mortgage rates for 30-year fixed loans going above 6%. And as we saw in one of my last videos a few days ago, just from 5% to 6%. I mean, when you have a percent increase in a mortgage, I mean, it might not sound a lot, it's just a percent, but it could cost you hundreds of dollars per month, making housing even more affordable than it has been. We're in spring right now, and springtime is typically the busiest home buying season. The upswing in rates has caused some volatility. It continues to be a seller's market, this economist says, but buyers who remain interested in purchasing a home may find that competition has moderately softened. And this is sort of what we need. We need it to be more a normal market, a more balanced market. It's good for everyone. As home buyer demand wanes, either one or two things could come next, a correction or a crash. And let's look at the difference. The former, which would be a correction, would entail a gradual drop in prices to more sustainable levels. It wouldn't be like the Titanic. It wouldn't just be, just there we go, into the iceberg, just off a cliff, right? Like little lemmings gone. Whereas the latter would result from either a rapid drop in prices triggered by widespread panic from homeowners and investors, or a wave of foreclosures like we saw in 2008, 2009. However, with homeowners leveraging more than $3.2 trillion in home equity and mortgage lenders enforcing strict standards, it's unlikely the real estate market is heading towards a crash, especially the likes of 2008. Working as a real estate agent and a lender, I've never seen buyers so qualified. People are putting 20% down, they have great credit scores, good savings in the bank, and people are just very well qualified. And then as representing listings and sellers, the offers we're getting, everyone's pre-approved. It's not like back in 2008, 2009, where there was these no-doc loans, subprime loans. We're just in a completely different market today. Now, to make sure you really stay up to date with all these changes in the housing market, you're going to need to smash that like button so more people can see this video and I'll help it do better. And also subscribe so you can stay up to date on the housing market. Thanks. Little plug there. Let's check out a chart showing people's equity in their homes. This is from CoreLogic. Annual home equity gains accelerated in 2021. You could see from 2011 and going all the way up to 2021 into quarter 3 right here. You could see the gains in home equity. And look at this, negative equity shares fall to record lows. Well, of course, right? So you could see going all the way down here to 2021. It's pretty impressive. This isn't the housing market of 2008. It talks about the COVID-19 housing market is drawing many comparisons to the real estate market of the mid-2000s. Two periods couldn't be more different. This is not the same market of 2008. This economist says it's no secret the housing market played a central role in the Great Recession, but in this market, it's just fundamentally different in so many ways. The housing bubble that led up to the 2008 crisis is attributed to a combination of cheap debt, predatory lending practices, and complex financial engineering that resulted in many borrowers being placed into mortgages they could not afford. This situation triggered a foreclosure crisis among homeowners and a credit crisis among the investors, all the banks who folded, who owned bonds backed by defaulted mortgages and birthed the global recession. In 2022, the real estate market is in a much better position. Almost all American households have rebuilt their nominal net worth to pre-recession values, and lending standards have tightened while home values have soared. Many would argue we're already entering a recession now, and the Federal Reserve is raising, 50 basis points. They're raising that federal funds rate, right, to stop inflation. But here's the problem. Monetary policies aren't normally seen in the economy till 12 to 24 months. So if we did go into a recession or a depression, it most likely would be, economists think, in 2023. And no one could tell the future and see if we went into a depression, how would that affect the housing market, even though the fundamentals seem very strong. As homebuyer demand falls, the real estate market is approaching a slowdown. According to the Census Bureau, U.S. new home sales have declined every month in 2022, and in March they fell to a 4-month low, highlighting the impact soaring borrowing costs are having on potential buyers. Higher mortgage rates, along with really strong home price appreciation, create affordability challenges for many home buyers, and that's going to slow the market down. Okay, according to Redfin, 12% of homes for sales had a price drop during 4 weeks ending April 3rd. That's up from 9% last year. Those are some of the reasons economists think there's going to be a correction of maybe 10 to 20% off overpriced homes, especially in really heated markets, versus a depression in the housing market, where prices fall 50%. Take a look at this chart by CoreLogic. The odds of regional home prices dropping over the coming year. Left is very low, okay? And you can see that's most of the US they're predicting, okay? Because we still have record low inventory, and even though mortgage rates are higher, people still have life changes. People get divorced, people have children, they need to, upgrade into a bigger home, more bedrooms, or they're getting older, they need to downsize. So there's lots of reasons people move, not just because they want a nicer home, but that could be too. Let's look at low. Look at this. The map even says California, the chances of homes dropping being low, because guess what? Households are being formed quicker than homes are being built. Here we have medium, and you could see sort of on the coast, on the east and west coast. High right there, so that is Arizona and Oregon. Look at elevated. There's some spots of Washington, Oregon, and then over here in Connecticut. Economists are still predicting that housing prices are going to go up this year, just not at the crazy rate we've been seeing for the last few years. My big takeaways for you: if you're planning on buying real estate, whether an investment property or primary residence, plan to hold for 7 to 10 years, right? Since World War II, there's been 12 recessions that have taken place, right? And this happens. The market, it's cyclical. We have bear and bull markets, right? So if you buy a home, let's say this month or next year even, and the market just tanks by 30-40%, hopefully that doesn't happen and we have more of a soft landing. But if that does happen and you hold 7 to 10 years, things will swing back around if you have to sell. Be cautious with loan products like adjustable rate mortgages, because with the Fed raising interest rates, if you're tied to a loan where the rate changes, it's variable, you could end up in a very high monthly payment, right? But if you're planning on moving in a few years, say 3-4 years, before that rate actually changes, you might be able to lock into a lot lower interest rate on an ARM than a 30-year loan. So you just have to see what makes sense for you, your finances. I encourage you to pay down debt on all credit cards, because with interest rates rising, your debt's just going to get a lot more expensive. Subscribe to stay up to date on the housing market, and if you need a lender in California, please give me a call. Thank you for watching.